Okay, we're live. So, welcome to the second episode of my new series, Nansen Unsupervised. So, each week I'll get on influential guests to talk about topics related to crypto and NFTs, and then also what they get up to. And we can answer any questions from the chat. So, make sure that you subscribe, turn on your notifications so you don't miss anything. Put all your questions in the chat, say GM. I'll reply to some of them in a second. And then also alongside talking, I'll also try to bring up some Nansen related content and give you some kind of easy ways to understand how to use it and how to relate it to actual reality, I guess. So yeah, and as always will be the case, I want it to be like super casual. So feel free to drop any questions. I want it to be interactive and like relaxed, so that's fine. And I should probably say actually, because I've got like two lawyers, they probably should tell me to say none of this is like obviously legal or financial advice. And yeah, final thing, if you want to sign up to Nansen, we have Nansen Lite link below for free. And if you want to trial Nansen Standard, it's only $9. So we have a second link below as well. So yeah, let's start off the episode. I'm going to ask you first, Wassie lawyer, to just give like a brief intro on who you are, how you ended up as Wassie lawyer, and yeah, what you're doing here.
Hello, everyone. I'm Wassie lawyer. So by day, I'm a restructuring insolvency lawyer, where I sort of deal with distressed debt. But more interestingly, by night, I sort of help build an NFT project by Wassies, where I do a bunch of stuff and also create needlessly complex legal structures. I think I've got my baby crying in the background, so I'm just going to hand over to Gonbe.
Okay, that's fine.
Yeah, we got a mini Wassie in the background there. Hey, I'm Gonbe. Don't really know how to pronounce it myself. I was like Wassie lawyer. I was a restructuring and insolvency lawyer for about 8 years. I was a senior associate in a Magic Circle law firm, and for the past kind of 18 months or so, I've been thinking about kind of, I guess, law reform stuff in relation to crypto, and that's basically what I'm working on.
Okay, so I think because normally I would give a longer intro and we'd talk about some more stuff, but I had a conversation with both of you two yesterday, and obviously we've only got 1 hour episode, and I want to get in as much interesting things as we can. So I think we would just kind of kick it off, and I'm sure that most people here are like most interested in the kind of 3AC situation. And what is likely to happen to them as they've obviously gone insolvent, and we had all this mayhem over the last couple months now. So yeah, we kind of want to get your perspectives on how it might play out. So Gon, do you want to start off maybe with like your understanding of the whole situation, and maybe give some like answers on where you think this ends up or how you think this kind of plays out?
Yeah, happy to do that.
Mm-hmm.
I don't know if people want like, I don't know if the baby's still there, but I don't know. I think you guys saw Wassie lawyer's tweet thread the other day, which just kind of explained what a liquidation is and how liquidation processes work. I don't know if people like want to think about that a bit, but we can talk about what you would actually do if you're a liquidator and what your kind of goals are as a liquidator. So basically, maybe you want to bring up the charts as well, because it's quite good to look at the timelines. But the liquidation for 3AC was filed, I think, on the 27th of June, and the liquidation order came in on the 29th of June. So that's like pretty much the Pico bottom, I think. That's like 1.1 ETH or something around there. Like, and obviously ETH is around what, 1.7 today. So that's an interesting element. One interesting thing I picked up today when I was looking through the docs was that the creditors filed for a liquidation for the appointment of a liquidator, but so did 3AC. And actually 3AC wanted a different liquidator to be appointed, but actually the creditors got their liquidators appointed. So that was a really an interesting thing that I hadn't quite noticed before. And the reason, I guess one of the reasons they would want to do that is because if you have a liquidator that you appoint, you get to choose kind of you get to choose which liquidator you get, right? So the creditors have chosen a particular set of liquidators. 3AC wanted a different set of liquidators, and that will impact on potentially how those liquidators go about doing their job. But broadly, their job is basically to collect in and realize the assets of a company, and then
Can I just
distribute.
ask you that? So you said that 3AC can possibly get a choice on their liquidators. Is that a thing? That seems surprising.
So a company can put itself in. The directors can resolve to put themselves into liquidation of a company if they think that there is no chance that the business can continue as a going concern, and that's their duty. They actually have a duty to do that if they think the company is insolvent and there's no reasonable prospects of success. So they actually did attempt to do that. I think they got in before the creditors actually, but then there was a hearing and the creditor liquidator got appointed in the end, which is really interesting kind of process point. I don't know if you picked that up, Wassie lawyer.
Yeah, we did. Sort of just to rewind, just so sort of everybody comes up to speed, because appreciate that not everyone listening is an insolvency lawyer, and or may not have the complete factual background around what happened. So as everyone knows at this point, 3AC Capital is in liquidation. What we do know happened is that they were extremely overexposed to the Terra ecosystem, both in terms of their Luna holdings and in terms of apparently they had reasonably large amount of US Terra. So when the whole ecosystem went down, they were in a little bit of a hole. They publicly said that they were okay. They said their exposure was limited. They told their creditors privately as well that they were okay and everything was fine. But it slowly started coming out that they were not fine. There are some unsubstantiated rumors that they may have tried to leverage trade themselves off the hole, but you will have to see where the liquidators get to with investigating that bit. So as Gonbe said, what happens when you run out of money and you're insolvent, which means you're no longer able to pay your debts as they fall due. As they say, oh, you just have more liabilities than assets. You've got broadly two options really. One, you get more money to come in so you can continue your business as a going concern, or two, you liquidate the company. And when the fund like 3AC, when like all these rumors started coming around, I basically thought to myself, hey, they're going to restructure the company, right? It's massive. Like someone's going to come in and provide some sort of rescue financing. What didn't happen? So it was actually quite surprising, actually, to everyone involved that 3AC went to liquidation so quickly, exactly because of the point that Gon just made, which is normally process-wise, what happens is if you default on your debt, and it only came out in, I think it was like the third week of June that 3AC had started defaulting on their debts and stopped replying to creditors. You normally have to serve some sort of statutory demand in the BVI, and that's I think 21 days notice or something. And after the 21-day period is up, your creditor can sort of apply to wind up the company. And so it was kind of surprising that 3AC went to liquidation incredibly quickly. And one of those reasons, and we sort of see this now from all the filings that's come out, is because 3AC wasn't even fighting the liquidation. They weren't even saying, hey, we're not insolvent. Hey, creditors, don't wind us up. Normally you'd see that. Normally you see, hey, we're not insolvent. Hey, we can find a way to save the company. No. They put in the liquidation. They put in the application for liquidation, voluntary liquidation, before the creditors even got there. So when he got to the hearing, I think when he got to the hearing, it was basically a case of, all right, so oh, sorry, I just got to rewind it very quickly to cover this point. What the creditors originally applied for was provisional liquidation. And that's essentially the sort of a process where you put in what they call provisional liquidator. So it's a professional that comes in and takes over the company. And the reason you do that is because you think that the directors of the company, aren't going to be acting in good faith. They're going to start, getting rid of assets, dissipating assets, etc. So the creditors, I think it was led by Deribit, put in a provisional liquidation application, and 3AC themselves put in a liquidation application. So when he went to the hearing, the hearing, the judge basically went, well, looks like no one's really opposing this, so it's within my powers, so I'm gonna dispense with all these notice provisions and all these other provisions that might normally apply, and just put it straight into liquidation. And Gon also made a really good point, which is they nominate their own liquidators, and the creditors nominated their own. And I think I tweeted about this. The creditors would be very happy that they got their choice of nominee in, because even though a liquidator is a professional third party that's meant to sort of liquidate the company, realize the assets in the best interests of the creditors or the stakeholders of the company as a whole. It's obviously better for a creditor if the person who's in charge of that process isn't best mates with the shareholders and the directors of the company.
Mhm. Isn't this related to like the way that then you can go after the assets? So I think
Cor-
Gon mentioned it yesterday. Like if you frame it in a certain way, like fraudulent, then you can go after like the personal assets. So then maybe is that why it depends on like who the liquidator is? So let's say 3AC got a choice of the liquidator, they probably would be more lenient and go for the options where like the personal assets then aren't involved.
Potentially, yes. I mean, liquidators have duties, so they wouldn't egregiously be, breaching their duties. But it certainly is the case that if there was a personal claim, maybe the liquidator is going to be a little bit more understanding, perhaps when they initially form a bona fide view of whether the directors were right or wrong. But we can get on that later. I mean, I'm sure a lot of people listening basically ask the same two questions, which is, can we sue and Cal in their personal capacity, and can we
Yeah.
seize their assets, their personal assets? Can we go after their wife's assets, and are they going to go to jail? That's like the questions that people just ask all the time, right? But we can address them.
Yeah.
So
Gon, do you
I
want to
think
add anything? Yeah.
yeah, so it's just interesting to think about what was a lawyer was saying about creditors or kind of recalling their loans or default or kind of enforcing on their loans all at once. So obviously in like I think it was like 9th of May, 13th of May sometime, Luna kind of went to zero, but in like the space of a day or the space of a few hours. And 3AC were heavily exposed to that, obviously. That prompted creditors of 3AC who had lent to 3AC to get worried about, well, they either need to post more margin on the loan or collateral on the loan, or kind of start repaying some of the loans and make sure that they kind of are less exposed to 3AC in that way. Because 3AC had effectively chosen to borrow on a generally unsecured basis and then use those borrowings, I think, to take some kind of reasonable, kind of potentially kind of leverage positions in the market and the GBTC trade, I think. But when all of your creditors call for your loans to be repaid all at once, that kind of puts a whole load of stress on your business, and then they had to start selling their Bitcoin and their other holdings in the market, which then drove the price down from like 24 to 20 or something like that, Bitcoin, which then kind of was even worse for them because they were realizing less and less kind of money from their collateral to repay their creditors, and they just couldn't repay them all back at once. So that was effectively kind of what led them to get into this spiral of not being able to repay their creditors and realizing that they were kind of at that point in time. I think even in the creditor statement from Kyle, he said they were hopelessly insolvent at that point in time. But the reason why it happened so quickly is clearly because Luna crashed so quickly, and then there was a big knock-on effect of that because everyone wanted to minimize their exposure to the Luna kind of ecosystem breakdown.
Like Kai was saying there, like you just mentioned, that they're like hopelessly insolvent. Is that why they basically were like voluntarily saying that as well? So is it an option like these other firms have been doing? I think it's with like Kirkland, everybody seems to be using to restructure. Was it just a case of like 3AC got hit so hard so quickly that they knew like there's no chance of saving this, so you might as well just be honest and say that it's like over?
And also I think it's because 3AC is a fund and it holds assets, whereas Voyager and Celsius, they have customers, they have like a business going on, so there is something to save. But with 3AC, or what are you saving? Like the assets themselves, maybe. So someone could come in and fires, buy them in a fire sale or something. But it really isn't like any sort of business the way Voyager and Celsius have it, right? To keep going. And yeah, I think it's certainly the case that they were hopelessly insolvent. They were probably in a massive hole after Terra and Luna, which they did not admit to. And then the fact that they just got into another hole, basically. Just two terrible episodes happening one after the other.
Can I ask you as well? Maybe you don't have the answer to it, but it seemed so. I think it was Genesis loaned them like $2 billion. I think they were like one of the largest. It's like, how does this
No,
happen?
they are the largest. They are the largest.
Yeah,
for
they
sure.
are. They are the largest. How does that kind of happen? Did they do due diligence and like they saw it was fine, or is your take that like these companies that were lending to 3AC, they just, I think, to me as like an outsider, I would think that they just kind of thought 3AC are this firm that have been around for like 10 years. They're probably fine, and like maybe did some background checks, but is that just like super naive? And they must have done them, surely.
So God and I have both seen like conventional company insolvencies, like massive billion-dollar ones, and you'd be surprised by how much lending can happen unsecured. Like people just get incredibly overconfident. And look, if we were in an environment 5 months, 6 months ago, and 3AC knocked on your door and asked you for a loan for 10% interest, you just give it to them. Because if 3AC goes into a shit coin that literally sells a piece of shit collateralized by more pieces of shit, you would literally be fighting for allocation, right? Because 3AC had that sort of reputation in the market. So now in hindsight, when we look back, we realize that they were swimming naked basically, and they were just, punting other people's money and everything, leveraging to the tits. But we are saying all this with the benefit of hindsight. Back in the day, a loan to 3AC is probably one of the safest loans you can make in crypto. Right? Because you know who these guys are, they're an incorporated company. You could actually sign a document with an actual company, which isn't the case with most of the loans in the crypto space. So, yeah, was it poor risk management? Yes, it's garbage risk management by conventional standards. But crypto risk management.
Yeah, we've seen lots of unsecured lending like that in other companies. Like you just don't think it's going to happen, then it actually does. It's pretty weird. But I think you also have to think about the business models of the lenders. If you think back to the kind of the bull market, at least towards the end of it, it was a very yield focused market, and their business models of those lenders was really trying to get more customers onboarded so they can benefit from fees, and they can also benefit from using their kind of customer deposits to generate revenue. And the way that they generate revenue is by lending to borrowers who think they can generate more revenue. So 3AC borrow, and then they think that they'll do trades in the background that generates them more revenue, kind of the Lunar ecosystem trades and the other trades that they were doing, potentially the leverage trades. And they'll pay a fee to Voyager and Celsius to get those loans in size. And also from a crypto, I know that Celsius and Voyager aren't that crypto native businesses, but effectively from crypto native businesses. So it was all about like this generating yield, which is at the end of the day trying to capture customers and capture customer interest. So you've got to think that those lending businesses were trying to be highly competitive at that point in time. So they did take a risk management decision. It was obviously a wrong risk management decision at the end of the day, but they took the decision to lend on a uncollateralized or a pretty lowly collateralized basis and on pretty reasonably loose terms on purpose, because they thought that gave them a decent yield vis-a-vis a reasonably kind of safe, well collateralized, partly OG, pretty rich set of guys who'd been in the market for quite a long time and had previously been doing reasonably sensible kind of arb trades. So that's the kind of the overall reasoning. It was of course wrong, and lots of people in the market particularly pointed out the Lunar Terror ecosystem kind of potential failings around the Ponzi-nomics, which was used to kind of generate again yield generating to generate user base, right? That was really characteristic of this at least the last element of the market. So it is understandable and it is explainable from a business perspective. It was just a bad business decision at the end of the day and bad risk management, but there is a reason behind it.
I think that's absolutely right. And Gon just made a point. I mean, he made that point, and it just got me thinking that, in fact, the entire reason why I feel like the entire reason why all of this collapsed is because of that yield arms race that he was talking about. Because everyone was trying, a sensible yield that you could give to DeFi customers. Like, maybe it was Dokon, maybe it was Terraform Labs, maybe it was someone in the system that said it was probably somewhere around 7 to 10%. Just pulling the numbers out off the top of my head. But the thing is, now you've got this yield arms race where everyone's trying to get users, and what are you trying to get? You're trying to get retail users. You're trying to get people who don't think they're traders, who just want to get some exposure to crypto. They want to get some good interest rates, and instead of offering them, I don't know, 3%, 4%, 5%, which would be amazing compared to the banks that they were presumably using before, you start having this weird, well, not weird, but this crazy yield arms race where everyone's trying to give their users like 10%, 15%, 19.5% per annum. And yeah, at the end of the day, I wonder how much of it was actually dictated by UST and Terra, right? Because what UST did, like Gon said, they had this like, well, sort of semi-Ponzi-nomic stuff where you basically printed more UST to pay people interest in what you said was a stable coin. And it's a bit hard to catch up to 19.5%, right?
Yeah, I think it was characteristic of this whole last market, at least the latter half of it, which is really annoying, really, because it became yield as a product, or you called it like a yield arms race. Yield became the product effectively, which is really bad for the ecosystem as a whole, because what you want in an ecosystem is good product to be the product. You want good user experience, you want low fees for users, you want safe custody for users. If you're a custodian, you want to actually do a good job of being a custodian and like give simple, understandable terms to people, keep their stuff safe. And if you do generate yield with it, tell them what you're doing with it and tell them how you're doing it and what risk they are getting from it, so they can price that risk in themselves. But really, you shouldn't be kind of, so it really diverted the product from being a good, helpful, financial, decentralized, partly product for people to being product is yield. And that's kind of characteristic of a lot of projects, I think, which is probably bad for this like cycle.
In fact, it was
So go ahead.
I was going to say, in fact, it's absolutely terrible. And I've sort of commented on this a couple of times, because if in this cycle, if you got absolutely, completely wrecked, it wasn't because you were a degen shitcoin gambler. It was because you believed in these guys who said, hey, don't do any of this trading, leave it to us, come and enjoy your 70%, 80%, 90% interest, right? If you were a degen gambler and you bought the shittiest shitcoin at the top, you're still holding on to some assets right now. Maybe you're like 80% down, right? If you bought Bitcoin at 60K, you're 65% down. But if you did the right thing, you did the quote unquote responsible thing and put your money in quote unquote a crypto bank like Voyager or Celsius, or you put your money in a quote unquote stable coin like US Terra, you've got nothing. You've got nothing left. You've got what, 5 cents on the dollar on US Terra, and you've got something to be offered to you in the distant future when Celsius and Voyager are done paying Kirkland and Moelis and all these professional advisors off.
Yeah, what's the new Luna token called? Lunch token? Lunch?
Yeah, Lunacy or so, Luna Classic. I think you make such an interesting point. Like last cycle, I think there was an obsession with APY. Like obviously we saw that with Luna, but there was everything like Ohm, and there was basically like a race to make the most interest from your tokens. Instead of like innovating to make like a safe DeFi platform, which is actually what we need, especially in the long term. But then maybe last year's, like, this is always what people say, but you'd feel like last year, now we hopefully should learn. And I think people are a lot more cautious currently. I don't know how long that sustains, of like high APYs and feeling like, okay, maybe there's something dodgy. You don't understand the yield. Where is it coming from? And then maybe we get to a position where we don't have just a race to get the highest APY. We just have a much more sustainable system where these DeFi platforms are actually here for the long term and they're safe. And I also feel that a lot of people had trust in these like CeFi DeFi kind of like mixed ones, like Celsius, and have now learned that that's actually arguably a worse option, because then you're like under the instruction or whatever, or management of these people that you then have to trust yourself as well. So I think it's such an interesting point of like the product became the yield, and that is a really bad thing. So hopefully that changes, but I don't know if that actually does. We'll see.
Yeah,
we can talk about like how you might structure custody arrangements in a little bit better in a second. But I think that I don't really want to talk about regulation that much because I don't really know much about it. But I think that the legal and regulatory environment for tokens and new token issuances and new products has potentially exacerbated that kind of rush to yield or yield arms race environment, because before, or at least back in the day, when you could issue an ICO to everybody early doors and everyone just kind of rolls in, at least it's fair. But 99%, 99% of the time, everyone got a fair opportunity to participate in a scam. But when 1% of the time, they got a fair opportunity to participate in something cool and useful and valuable over time. Now, that is harder to do now. You can't have like an immaculate conception like you can have in Bitcoin. You can't really do the kind of semi-ICO type thing that ETH did, and because everyone will just rush into it. You can't really sell into the market because it's going to be a securities offering probably. So what you have to do is you have to build up this social participation quickly by getting people to participate in your market. And the way you do that effectively is by putting on these massive yields so that people yield farm and you get eyes on it and you get high TAV in this system, and then more people want to you kind of like bootstrap yourself that way, which is effectively what Do Kwon and the Luna ecosystem were doing. They were trying to bootstrap themselves quickly, using their own, like running off their own treasury. So they knew they weren't able to do it for a whole time because they had a limited runway of treasury. But they thought if they bootstrapped enough, they got enough social participation, then maybe they can kind of wind down those yields, but enough people will stay in the ecosystem. So I think that yields arms race is partly, not all, but partly kind of like more symptomatic of the wider legal and regulatory structuring environment. But that's just kind of like my broad thoughts on that. And people have said that before, so it's not like a new thought.
Yeah, no, I absolutely agree with that. I will almost say that this is almost a natural evolution, right? Because previously, like as Gon has just very elegantly put out, previously you had the ICO bubble, right, where everyone basically could participate in all of this sort of pseudo equity, and then suddenly, I mean, I recall there was this period where everyone was very interested in what security was. I mean, people still are, but there was this wave of people going, "Oh, this security, it's illegal. You can't do that." Mainly because the SEC was punching a few people in the face. But then so the narrative sort of shifted to you need to get in on the next big ICO to, okay, you're all too dumb to participate in securities offering, or this illegal and the suits are going to get us, or the feds are going to get us. So it became the VCs and all these guys coming in going, all right, don't worry about it, guys. We got this, right? We're going to set up a DeFi platform where you guys can all participate, and we're going to go ahead and make all of these investments. And that's exactly what happened on the side. Because when you look at Celsius, you put in all your money in Celsius, and what they've done is they just went and made a shit ton of degen plays. Degen, they set up their own mining company. Fine, they gave Ethereum to companies that lost 35,000 Ethereum, just lost that amount of Ethereum. They gave it to people to trade in LPs without a contract, and they were they apparently weren't hedging. So it's kind of crazy, right? Because you sort of believed in this, that these guys are like sophisticated and you're never going to make money in the market again because they're going to arbitrage everything. But no, they're just like you. You just gave them money to make all the degen trades and take all the upside, and when they get completely screwed over, you're the one holding the bag. You're the holding the shitty debt.
Yeah, I think that's a huge lesson that we've all learned. Like, you kind of had this faith in these institutions, like they're not just like us, that they have like more information or they have better risk management. But we've kind of learned that that's not true. Like the whole Celsius thing, I'm sure we could do a whole episode on, but I obviously don't have as good understanding as you. But it just seemed kind of outrageous to me, right? They were like, you loan them your ETH or whatever, they'd then convert to another token. They then didn't have enough to like pay back your ETH, so then they'd have to start selling other people's crypto to pay back the ETH. And yeah, I think we know what that structure is. It's a complete mess.
The interesting thing is that it's entirely consistent with a normal custody relationship, right? You can structure custody relationships however you like, and if you structure them in a contractual way, then effectively you deposit your ETH with Celsius under contract, and you have a right against Celsius to get that ETH or a substitute of that ETH, so not the same ETH back. And that is entirely consistent with contracts. It's just that because people in the market, I think, particularly the crypto market, use custody as a term that kind of, particularly because I think it's arisen from kind of self-custody and not your keys, not your coins. Custody sounds like it's a safe thing. But the word custody doesn't necessarily give you any legal consequences. You need to look at how that custody arrangement is structured, whether it's under contract or potentially whether it's under trust. Now, if those custody relationships had been structured under a trust structure, instead of having a contractual right against Celsius, you would have a beneficial interest under a trust in respect of those deposited tokens. So therefore, those tokens would fall outside of their insolvency estate. So you'd be able to get them back in preference to other creditors, unsecured creditors. So yeah, we kind of diverted off to market talk, which obviously I'm not qualified to talk about, and loads of other people have talked about it way better than I have. So sorry about that, but we can maybe talk about what liquidators do when they're trying to realize assets. And if you want to talk about, like, you probably don't want to talk about structuring custody arrangements, but we can maybe go back to like how
I'm really interested. Yeah, I think the issue is, like, I'm really interested, but I know not everyone probably is. So I think actually you make a good point, because somehow we're already 30 minutes in. Shall we talk about, like, now what will happen? So now that we know that the liquidator is chosen right by not 3AC, so everyone else, right? Should we have a look at, like, their assets that we've already got? Because on Nansen we can have a look at, like, the NFTs that they've got, and then maybe you could go through what can potentially happen to them.
Yeah, that sounds good.
And the goal is, remember, as a liquidator, you're basically trying to get a bigger pool of assets as you possibly can so that you can give them back to creditors. And you're going to share them with creditors generally on a pro basis.
Okay, so this is, like, their main wallet with their NFTs in, at least. They do have some wallets with crypto. There's, like, one wallet with, like, $38 million of stable coins, which has been, like, untouched. And I think that's the only one with any, like, substantial amount of crypto in. But yeah, their NFTs is probably the most interesting point in terms of what happens to them. They have a lot of fidenzas, which for some reason aren't showing, but if we can show here. Yeah, so they have 31 fidenzas, and fidenzas about 100 ETH each. So 3,100 ETH, how much is that? That's asking me too much. 50 million? Is that terrible maths? I think ETH is like 1,700 now. So yeah, they've got a lot basically of value still left in these NFTs. Punks,
do you have an
11.
aggregate value for their NFTs?
Yeah, so we estimate it at 2,600 ETH, but for some reason the fidenzas aren't showing up. So that's disregarding them. So on top, how much did I just say that was? 30 something, 3,000 ETH. So it looks like they've got about 5,000 in a liquid market, I guess, worth of ETH, worth of NFTs at least. So, like, how do you see this playing out? Is it the case that these NFTs definitely are going to go? Like, is there any situation where they're not? Which might sound a stupid question, but people might have that as a question. And then how does that play out? Is it something that's probably likely to just be like an OTC to buyers? But it seems so much. That's why it's confusing, especially 30 fidenzas. How do you shift them?
So it really depends, and a liquidation isn't going to happen overnight. So you're not going to see the liquidate. You probably, if they're any good, they're not going to, and they are good. So they are a very good firm. They are not going to go into the market and fire sale 30 fidenzas at 80% haircut or something like that, right? They're like Gonbe said, their duty is to realize as large as an asset pool as possible, presumably within a reasonable time frame. I mean, I was going to say, before we think about how they get rid of them, we should ask if they even have control of them, but maybe that's not a question. But assuming that they do have control of them, there are a few ways this can be done, right? If the market heats up and there is demand for it, they could sell them in slowly and get rid of it at fair market value. Potentially, they could run an auction. They could run an auction. People could participate, and therefore end up paying, what should look like fair market value for it. And yeah, I mean, you could do an OTC as well, but they would have to determine that an OTC is the sort of the best likelihood of them recovering maximum funds.
So I was trying to show the fidenzas, but it looks like it's classic slow OpenSea. not loading, so I can't actually show you them. I'll try and come back to that so you can have a look, because it's interesting to see the prices that they actually bought them at.
When's the last time they bought?
Let's have a look. 1 second. So most of their transactions are them receiving, some people sending them some scammy stuff. Let's see. I think it's a long time ago. Here we go.
Oh, they own a lot of magic penguins.
Yeah, a lot of penguins. Almost a year ago, were they actually buying anything? Alien.
They also
Art block.
sea hams.
They have what?
Sea hams.
Oh, sea hams. Yeah.
They're funny.
Which were a lot of money at the time, anyway. Yeah, a lot of penguins. So they're probably all going to be dumped, which is kind of sad.
We got other deed. When did other deeds mint? Wasn't that like July? Or was it not?
Oh yeah, is it showing other deed? I don't know.
Mint was.
If they have other deed, that's interesting. Yeah, they do, right? Free. Ooh.
When was
Did I
that
miss
mint?
a buy then? Let's see if we can filter. Hang on a sec. Yeah, that was definitely not a year ago. That was like a few months ago, I think. Let's have a look. Oh, dude, other side. Oh, minted 89 days ago. Oh, yeah, so they did mint. You're right. Oh, of course, because they own apes, don't they? I'm being stupid. So we should look by their mints. Let's see when they last transacted.
Yeah, I think it was early May, wasn't it? So probably before they were insolvent, because
it was the top.
It's literally the top.
Yeah, that was the last thing they did.
Yeah.
Minting other deeds was their last action before.
Did they at least get a coda on there?
I don't know. That's a good point. I think that will take some more research.
So yeah, one of the things you can do as a liquidator is, obviously, if you've got a pot of assets and you know you've got the keys, or you get a court order for control over those assets, you can sell them. That's like a pretty obvious thing. If you've got some stuff, you can sell it, or if you've got some cash, you can give it back to creditors. Pretty straightforward. There are like two other broad tech things that a liquidator might look to do. One is to reverse or claw back transactions or claims in respect of transactions that happened in the last that happened before the insolvency, which is one method of getting assets back into the company. So unwinding transactions that happened just before the onset of insolvency. And then the second one is bringing claims, I guess, directly against the directors for some form of wrongdoing, basically, leading up to the insolvency. And that's a different type of claim, because instead of unwinding a transaction that happened, it's actually going against the assets of the directors. Now, whether or not those directors, Kyle and Sue, do have any assets anymore, or have any realizable, easily accessible assets, is like a bit of another question. But there are potentially claims that liquidators could make against directors if they were minded to do that, and if they thought they had a decent chance to be successful in making those claims, given the cost that it takes to put together a claim against the director of that nature. But those are the other two broad ways in which you can kind of make your pot bigger for creditors. I don't know if Wassie Lawyer, you wanted to go through those in a bit more detail.
Yeah, sure. I can sort of talk about those clawbacks a little bit. I was sort of thinking of something else, but the sort of potential clawbacks or avoidable transactions, I mean, and they're sort of fairly common across most first world insolvency jurisdictions, including the BVI. So this law's applicable there. You have unfairly preferential transactions, which essentially, if, let's say, I've got $1 million and I'm in a bit of a spot of bother because I owe Nansen intern $1 million and I owe Gonbe $1 million, and I just decide, because I'm mates with Gon, that I send him $1 million, so I've got zero left, and Nansen intern rocks up and says, "Hey, give me back my money," and go, "Oh, I've got nothing, man. You can sue me, but I've got zero. I'm bankrupt. I declare bankruptcy." But that isn't a complete trump card, because what happens is potentially whoever's liquidating my estate, which is $0 in it, can look back at the transaction that I've made to Gone and say, hey, that's an unfairly preferential transaction. We're going to claw it back and we're going to distribute it more equally. There are also claims against the directors, and this is something that the liquidators will look at, that the creditors are going to be very, very interested in, and they're going to be pestering the liquidators about it, given how this whole thing blew up. Would be or what is known in the UK as the sort of wrongful trading, fraudulent trading line of doctrines. So essentially, what happens is, if you know that you're insolvent, if you know you're in a very difficult position, sometimes we call it the twilight zone, where you're not sure, but you may become insolvent. Once you become insolvent, your duties as a director is to the creditors, and you cannot then go out and make incredibly risky leverage trades, because this becomes wrongful trading, and I think it's broadly defined as something like, if you were reasonably aware that the company is insolvent, and you continue trading, something along those lines. But that would
We've seen, yeah, that's what I was going to say. Like, from the evidence we've seen, obviously we're not making a judgment, but it looks like that seems quite clear, right?
It's going to be the liquidators to make the judgment, right? And if it was the
Yeah.
case that after Luna blew up, that 3AC were in a hole where they were already insolvent at that point, and they continued trading, they continued borrowing, they continued, lying to the creditors and making all these apparently made all these risky leverage trades, certainly there'll be wrongful trading, and the court would have the power to say, well, you're liable, so you're gonna have to contribute your personal assets to pay back the creditors. Not sure if Gon has anything to add to it.
It's a really interesting question, I think, because yes. So the first point that you made was really interesting, was your lawyer. I think that people just need to think about it again. Normally, when you're a director of a company, you have a duty to your shareholders to act in the best interest of the company for the benefit of the shareholders as a whole. That flips when you kind of in the twilight zone, or when you're in an insolvency kind of situation, to be for the benefit of the creditors. So then you have a duty to preserve assets instead of going out to try and make more money, broadly speaking, right? This happened so fast. The Luna liquidation the Luna kind of crash was so fast that they effectively lost, what was it, 400, 600 million overnight. Whether or not they were insolvent at that point or whether or not they kind of thought they might be, or that they had no reasonable prospect that the company could avoid a liquidation, is another question, because most of those loans did not have like a maturity date on them. And most of those loans didn't necessarily require like that heavy posting of additional margin or collateral. So there is potentially an argument that they said, well, so long as our creditors still believe in us, so long as they don't start calling these loans, we can still continue to trade, because we don't actually have any liabilities due and payable right now, unless the creditors turn those undated loans into a loan that is due and payable, or unless they accelerate on the loans or under the guarantees. So that will have to be like a really factual, and I think there's loads of messages and stuff, like the really famous one. There are quite a lot of messages where like they creditors do that, but that was over a 2-week period post Luna. So actually identifying the point in time at which they thought there was no longer any reasonable prospect of success for the company will be a very difficult question, I think, and that will then impact on whether or not the liquidators can bring a fraudulent trading claim, whether or not they can bring in a wrongful trading claim which doesn't need any fraud, and it might also impact whether or not those kind of antecedent transactions or clawback transaction claims are successful or not. So it's a really interesting factual matrix, and it might not be as simple as some Twitter threads make out, because it's just like it's always a nuanced, difficult issue when you actually get into it.
Does that become more difficult in crypto, because it's like, I'm guessing that's a more subjective issue, like did they have reasonable ability to like not become insolvent? Does that become like more difficult in crypto, because like everything's a risk asset? So like, how do you determine that?
I was going to say, it's an incredibly good point that Gon made, because of the way 3AC's loans are structured. I mean, I'll try and answer your question later. Or maybe hopefully this semi answers your question a little bit. With a more traditional company insolvency, right, you would have dated loans. You have loans that become mature at a certain point of time. You can't pay that. You become insolvent. Normally, because of how these loans work, you have acceleration clauses. If you default on all your other loans because they cross accelerate, and then that kind of like brings you to this sort of death spiral. But once you default on it, you know that you're basically insolvent because you've triggered events of default everywhere, and all of these loans become due and payable. With 3AC, it's not that simple, like Gon said, right? Because these loan agreements, I assume, probably weren't as robust as you'd expect your, standard LMA loan agreement to look like. And from what it seems from some of these filings, they seem to be recallable on demand. So at any point of time, your lender's going to come to you and say, "I want my money back." And that seems to be exactly what has happened after the Luna thing, where lenders were wondering, should I ask for my money back? I can just give them notice and say, hey, give me money, and they have to pay me back. And that's when they said, hey, all right, maybe I can't be completely honest with these guys, because if I were, it would trigger the quote unquote bank run. Because if I were completely honest, like, yeah, we kind of got like mega wrecked, and if you ask for your money back right now, we could pay you, but if someone else asked before you, then maybe we can't pay you. So and maybe that's kind of what drove them to lie and obscure the truth about the current situation, because they kind of knew that those loans weren't due and payable right now, but if someone knew what was happening, they could be.
It's a really interesting point as well, because if you think about what happened in the last year or two leading up to the Terra Luna crash, people in the market had lent them like 2 billion, or what was it, 4 billion, or whatever it might have been, right? So banks, like crypto banks or centralized type crypto banks, had lent them a whole load of money. Like Wales had lent them a whole load of money on an unsecured basis. Loads of people were very happy to lend them money, and they may well have thought, well, one way in which we can survive this market downturn is by borrowing more money, right? Because we are like well known in the market. If we borrow more money and we make some more trades, if this is like a Pico bottom and it goes back up, like it has gone up kind of almost doubled, not almost double, but you know what I mean, like since then, and they'd have got some leverage trades on, then they may well have been able to repay some of those loans, perhaps not all, right? And they may well have thought that actually if they got more loans in, that might have alleviated the problem. But it's pretty delicate at that point, because it goes a bit from being like, maybe in a bull market that was a reasonable argument to make, to being like, no, that's a joke. You really should not be borrowing more money at this point in time to try and pay off other people when you're literally hopefully insolvent. So you can kind of see a little bit the thought process and the reasoning, and the risk, the kind of like the contagion mitigation that they were trying to go for. Perhaps it's just that in hindsight, when it all tumbles down, it looks really, really bad. But in those few days, no one was really expecting it to happen, and you can kind of, maybe you can put yourself in a position where you think through why were those decisions made. That's like not to defend any of the actions at all, right? And not to comment on any of the actions at all, whether or not they're fraudulent. But like, that's the best I can do on thinking why those kind of decisions were perhaps made at the time.
I think that happens to everyone. It's that like make it back in one trade meme. I swear, like they have that temptation.
Correct, and we certainly don't know the complexities of their structure. I mean, for what we know, 3 Arrows Capital are like multiple funds. I mean, let's just not talk about Defiance and Starry and all these other funds yet, right? There are multiple share classes within 3AC, which could be indicative of, potentially multiple funds. I've not looked into that much detail. There are allegations that they may have been in control of certain treasuries, which and the nature of what the relationship with those monies is unclear. So it certainly could have been the case that they were so massively overexposed to Luna that it completely blew a hole in their own trading assets. It potentially could have been, shit, we just lost a large amount of our portfolio company's assets. I'm not saying that happened, but there are allegations that they may have happened. And therefore sort of fuse this desire to, shit, we need to plug this hole. We need to find a way to make it back, right? Well, they were already very bullish Bitcoin. That much we knew. They certainly weren't psyopsing us into and counter trading us. They're really very bullish. So when Bitcoin dipped, they very likely, or crypto dipped, they very likely went home. Maybe this is our chance to like get into the cheap and get out.
Mhm.
As long as no one knows that there is a hole in there and we fix it, then it's fine, right? It only matters
Mhm.
if the house of cards comes falling down.
Mm. I think we had a conversation last week on last episode. Is like thinking that, like, my view is that they just were genuinely so bullish, like genuinely did believe that this was like the super cycle, and things were just going to return quickly. Like dips would be relatively short or shallow, respectively. So they were just wrong. Like I think they're obviously reckless, but I think they were just so dedicated to that trade in terms of like longing dips and this being a super cycle but it just completely messed up everything because of that thought process. Because we only got 10 minutes, I wanted to cover, because it's really interesting, like that association with Starry Night. So Starry Night own a ton of NFTs as well. That was their NFT kind of fund. So what I think, Wassie Lawyer, you had a good understanding of like the kind of connection between both and what might happen in this situation.
Yes. So Starry Night and so Defiance and some of these other funds are in a very difficult position because we've now seen the documents for Three Arrows Capital come up. And what you see there is that you've got Starry Night and Defiance and this fund called Wobbler, which are all different
Mhm.
share classes under a single 3AC fund. So to sort of viewers that aren't finance people or legal people, so in a company you can issue multiple share classes and provide different rights to different share classes. So in this case, what they were doing were they were forming multiple funds under the single Three Arrows Capital company, such that let's say if you want to invest in, let's just say, fund A that traded exclusively Bitcoin spot, no leverage, they would give you A shares. And if you wanted to speculate on their more speculative fund where they trade up to 10 times leverage, maybe you get B shares. And maybe if you wanted to go into NFTs, they'll give you C shares, right? And the profits from the A shares, the profits from made from trading Bitcoin spot would basically go back to the A shareholders, and the profits from making those leverage trades would go to B shareholders, NFT to C shareholders, and so on and so forth. So that's broadly how it's meant to work. And this seems to be what they've done across the board. And you've got Starry Night shares, which is a separate NFT fund managed by a completely different person. From what we understand, it's not the core, it's not Sue and Kyle that were managing the Starry Night fund. This was sitting within the Three Arrows Capital umbrella. Now, this is all well and good if everything is going up. If everything's going well, that's fine because you can allocate the profits according to share classes. When it doesn't work is when something goes down. When the when the account of, let's say, Fund A and Fund B are now negative $500 million. What happens then is that in a liquidation, if Fund C is at $1 billion, the assets of Fund C would be used to pay off the creditors of Fund A and B, even though even though the liabilities were allegedly meant to be incurred by Fund A or Fund B on their own. And that's because they didn't have what we call segregated balance sheets. They had the same single balance sheets, even though they had internal accounting to sort of allocate the profit. That doesn't work in an insolvency. There is no special crypto regime for insolvencies. Like it just doesn't work that way. So as far as liquidators are concerned, Starry Night assets are probably a part of Three Arrows Capital, and we see this in the file recognition filing in Singapore. Um, there's a document that said that pretty much says that, right? The company's assets, they consider Starry Night to be part of the company's assets. They consider Defiance Capital to be Defiance assets to be part of the company's assets, and they consider the assets of the Wobbler Fund to be part of the company's assets. So it fucking
Wow.
sucks, to be honest. I don't want to be those guys. But
Yeah.
imagine, imagine if what you did was you you had these guys, they come use our structure, use our name, and you basically get
Yeah.
wrecked because of their recklessness.
Wow. Okay. I think the like common understanding as well was that like, well, my understanding was that Starry Night was like not immune, but maybe would be able to get off with like not having all their stuff taken. But like when I was talking to you, I was like, okay, maybe that's not going to happen. But I didn't know that like all Defiance and everyone else is also
like a lot of the stuff that we've been talking about is kind of like hypothesizing about what people were doing when and how they were structuring stuff and the sales they made and the transactions they did. But a lot of whether or not those claims, particularly like the fraud claims, are successful, will also depend on like the representations that were made to the counterparties to get those loans and to enter into those trades and what was actually said and stuff. So I think that's like an important element as well. It's not just like factual what the transactions were. It's also what did they say the transactions were, or what did they represent, or what did they let people think the transactions were, which will impact on like whether or not the fraudulent elements are successful, I think.
Mm-hmm. Can I ask you, like, as a general question, because like we're coming to the end, probably can go on forever, but how long do you see this whole process taking? Is this like a really, because like the more that I talk to you, the wider spread that this sounds like it is. This sounds like it's going to take ages. And then I'm like, my confusion is, how do companies like Genesis, it was Genesis, right, who like lent them $2 billion, are they okay to just not I know Genesis must have a load of money, but are they really going to survive this long, like with 2 billion gone? It seems like such a bad situation to me. I know it is, but like more that I talk to you, the longer this seems to be playing out, actually.
It's likely going to be at least 2 to 3 years, at least minimum, right?
Yeah.
Minimum 2 to 3 years. And so question of Genesis, I think exposure is about, they're claiming for 1 billion plus, because I think they may have had some collateral, right? I'm not 100% sure. I think they had some collateral, and then they liquidated it. But that will lead us to another conversation, which we do not have time for, which I think is super interesting, about whether you could potentially claw back the amounts they paid themselves using the collateral. But yeah, God and I can probably talk forever on that one.
Yeah, and remember, like if it's 2 to 3 years, you need to pay Ogier, you need to pay Teneo, who are the liquidators. They need to pay lawyers to do this stuff. You probably need to pay forensic people like you guys or other guys who do the forensics on all of these transactions. And the cost of the liquidation and the liquidators' remuneration come out ahead of creditors. So every day that you spend paying the liquidator is less money that comes back to creditors. So yeah, you don't normally see high realizations in liquidations. They're pretty low, right? It will depend on the assets, but yeah, it's not going to be high.
Yeah, you absolutely will not be realizing that much, to be honest. And I mean, I'm sort of going to reference something that SBF said, right, when he submitted that offer, or FTX Alameda submitted an offer for Voyager. He basically made that point, which is essentially your advisors and your professionals could keep paying themselves at the top of the waterfall because they get paid first, and what's left, and they're basically being paid out of the asset pool that's meant to be distributed to creditors at the end of it, right? So if you've got $100 million in the pool and you pay 20 million to your professional advisor, you have $80 million left to sort of distribute to other people. So yeah, professional advisor costs 100% something you need to think about.
Yeah, and that offer from SBF or from FTX excluded the 3AC loan, so they pretty much like didn't attribute much value or much hope, I guess, to much coming back.
Interesting.
I don't.
Correct. Yeah, I mean, Voyager. What Voyager has done themselves is that they've just shifted the default risk on 3AC to their own account holders, right? They're going, all right, we'll give you a piece of the 3AC loan. Well, really don't think it. I really doubt it's going to be worth that much because of the asset class we're dealing with as well. I mean, even if you're saying, okay, we could go on a bull run and we could get all this money back, but potentially it comes down to how, like, will the liquidator be able to control all of these assets? Will they be able to get Sue and Cal to surrender all these assets? To the extent that there are claims against third parties, to the extent there are clawback claims, will they be able to pursue them and be able to recover monies from them? It's all a big question mark, to be honest. And there's a lot of questions for liquidator, to be honest. Like in this case, it's going to be very new to them. They're going to be they're good. I mean, they already are sort of under fire. If you think about the Starknet tokens, like Starkware tokens, was it? Right.
Yeah.
There's that token. There was a
Starknet.
token warrant, and
Yeah.
and then there was the question of, all right, should the liquidators be exercising those warrants? There's a
Mhm.
question. There's an argument for yes, argument for no. They're there to liquidate. They're not meant to keep running a hedge fund. But
Mhm.
there's going to be all of these questions that's going to come very, very quickly at them, and they are going to be dealing with a very large crypto hedge fund that seems to be run quite improperly.
Hmm. Yeah, to me, that just seems like there is barely anything left. Like, obviously, it might seem like a lot of money, whatever, like 30 million in stables, if that's like definitely their wallet, and then these NFTs, which might they'll be worth millions, but millions is nothing when you compare, like when you think like they had billions of dollars of loans. So yeah,
Their
I can't see
liabilities are
people getting much.
correct. Their liabilities are now
Yeah,
at a minimum of $2.8 billion. That's their
minimum.
current
Yeah.
minimum, and that's, I think, on the initial assessment. I can't recall where that one came out, but yeah, it's the initial assessment, right?
Mm.
And honestly, the liquidation is so interesting. You can literally have like a 3-hour lecture on it because of all the interesting stuff it engages with. BTC denominated loans being one of them. Very, very interesting. What you get back, do you get BTC, do you get USD? Duties of liquidators, the potential clawbacks you could have against Sue and Cal, the unfair preferential transactions with Cal's wife. Yeah, it's a shit show.
It's a good like law school problem question.
Brilliant law school.
Did you do you know whether the creditors have proved when you are a creditor of a liquidator, you effectively have to prove in the liquidation, which basically means like say how much you think you're owed and like basically give some proof of like where your loan document and stuff or why you think you're owed that money. Wassie Lawyer, do you know whether creditors have put that proof in like BTC terms or whether they've put it in dollar terms? This is like a conversion point, Alex. Like it's like,
oh yeah,
because obviously if you prove in dollars and BTC goes up, then you get paid back in dollars. But they made BTC on their balance sheet, so it'd be interesting to like hear your thoughts on that.
We're not sure yet, right? All we know is at the moment there's been one creditors meeting, and it looks like I'm not sure how people filed the claims, but it does look like they've been dollarized. Probably, yeah. I mean, it's a difficult question. It's probably one for liquidators to figure out at some point. I'm not sure if they figured out already. If they have, I think we've discussed this a bit, right? There's probably going to be some litigation on it, if you ask me, depending on how they've done the conversions. Because normally you would have. Normally, it's quite uncontroversial because if it's a currency, if it's like US dollars, GBP, USD, you basically just euros, you just convert it to the currency of the proof. But this isn't a currency. It's not. It doesn't really fit in the definition of currency. So there will probably be a lot of fights over this one, and the value is large enough that people would fight over it.
Yeah.
Especially if BTC goes on a bull run.
Oh yeah, hopefully. So I'm gonna have to wrap it up because we've only got 1 hour. And I wanted to say, like you mentioned, it could be a good law school exercise, which gives me like PTSD because I studied law and this would be like the worst exercise. Actually, not a nice one. But yeah, thank you both for joining. I thought it was really, really interesting. And I think there's like endless more things that we could talk about. I know like we wanted to discuss like NFT rights and everything. There's so much in crypto related to law that I think no one really understands. So there's probably endless things to learn. So follow both of these two, Wassie Lawyer and Gon, on Twitter. Do you have your handles? Obviously, it's Wassie Lawyer and it's Gonbe Good, isn't it? I think. So
yeah, it's Gonbe Good.
Yeah, you just put out an amazing report actually, which features Kobe, right? Who like helped with it. So go check that out. Go follow both of them. Make sure that you subscribe so you don't miss next week's episode. And thank you so much. Have a good weekend. And that's it, I think. Goodbye.
Thanks so much for having us. Thanks.
Yeah.
Thanks for having us. Cheers.